All right, here I am. We
Hey,
got it.
wow. Can you see me?
Yeah, man. Like, what's that, the fourth time? All right, let everybody
Finally.
join. What's up, everybody? What's up, CCT? I'll do the introduction in a minute. Let me let everybody join in. There we go. Yeah, let's give it a minute. So,
Okay. There we go.
yeah, finally. 28 people. We had like 140 before, so they're going to join.
Yeah.
There's Joe. What's up, Joe? You should have like came on too, man. But you don't like me no more. You don't ever want to go live with me. Who else is in there? Hey, Emma, what's up? All right, we got 52 people on here. All right, here's what's going on, everybody. Now, brought to you by CCT. I got Andrew Gordon here. He is a tax specialist, accountant, lawyer. I don't know the proper legal terms.
You got it.
Did I get it right?
You got it.
Okay. Well, basically, I'm just on here to like host this, and I really don't know anything about taxes, so I'm going to give the floor to him and let him do his thing, and then we'll refer back and have some questions later, possibly, if he doesn't cover anything. But save your questions until he's done, because I have a feeling he's going to cover a lot of the stuff you're thinking, and that way we don't have to keep repeating ourselves. So, Andrew, if you want to take the floor, go ahead and, what's up with the taxes?
I'll start with some of the basics, and I do encourage everyone to ask questions because some of these areas are complex. But I'll start with the basics of crypto and tax and the things that you need to know. So just holding crypto itself is not a taxable transaction. So say you go on Coinbase, buy some Bitcoin, just holding it, you don't necessarily have anything to report to the IRS. Now later on I'll discuss forks and the implications of forks such as Bitcoin Cash and what that may mean from a tax standpoint. But merely holding crypto is not a taxable event. But often where people get confused, though, is when they start to do things with the crypto that they're holding. So, for example, buying a pizza or buying a Lamborghini, that is actually a transaction. That's a taxable transaction because it's more akin to the sale of the Bitcoin for cash and then using that cash to buy pizza or a Lamborghini. So there's a lot of people that now are getting debit cards and using those to spend from their wallets, using Bitcoin off of a debit card. Great technology, very cool. But unfortunately, from a tax perspective, a big pain, because every time you use it, say you use it to go buy coffee at Starbucks, now this is a taxable transaction. It's as if you sold your Bitcoin. And so when I say taxable transaction, what does that mean? Well, what I mean by that is if you have a gain, you're going to be paying the IRS some money. And a gain means that the purchase price that you originally bought it for and the price that you sold it, or in our example, bought the pizza or the Lamborghini, if that price went up, now you've got a gain. So say you bought the Bitcoin at 1,000, now it's 15,000 today. That's a $14,000 gain, assuming you sold the full Bitcoin. So that would be taxable, and often people don't realize that. So I often encourage people to stay away from debit cards, things like that, not necessarily using Bitcoin or crypto for day-to-day transaction purposes. So that's kind of one of the basic elements of taxing crypto. Now, taking that a step further, so a purchase of pizza or a Lamborghini, that clearly is taxable. Well, what if you use your Bitcoin and then buy Ethereum with it? That, while there's debate within some of the online forums, and you see a lot of people discussing it, that's actually not, it's not just an exchange. That is a taxable transaction. So let's walk through that. All right, so say you have Bitcoin, now using that to buy Ethereum with it. From the IRS's perspective, it's like, again, you sold the Bitcoin and bought Ethereum. Sounds crazy, right? It's as if you sold the Bitcoin, got cash, and then bought the Ethereum. While in fact you may never have gone to fiat, it is taxable. So important to realize that as well. Hey, Todd, you seen these messages?
Yeah, what's up?
They're asking you to stop vaping. They're asking you to stop vaping. They're saying it's hard to hear.
Yeah, right. Is it
No, I'm
really?
serious. They're saying it's hard to hear. You're
Oh.
vaping. Maybe go on mute. All right. So we'll talk a little bit about what's referred to in the tax world as a 1031 or a like-kind exchange. And one of the questions that someone's asking is, if you're not going to fiat, so you've got Bitcoin going to Ethereum, if you're not going to fiat, why is this taxable? Well, again, just because you didn't go to fiat, it's almost as if you're selling it and going to currency and then going to the Ethereum. And that's because from the IRS's perspective, this doesn't qualify as what's known as a 1031 like-kind exchange. And a like-kind exchange is most commonly seen in the real estate world, where, for example, you've got a house or an apartment and you sell it and then buy another house or apartment with those proceeds. And then you don't show a gain on the sale of that first home, for example. That would be a like-kind exchange. And now people are saying that this should be the same in crypto, that if you go from Bitcoin to Ethereum, it's just the same as if you're going from a house in California to a house in Illinois. House is a house. Well, from the IRS's perspective, that's not the same. And actually, there has to be a number of things that are taken into consideration when a like-kind exchange occurs. So one of the requirements is that the two items that you're exchanging are of considerable characteristics that are similar. And this requires a legal analysis. And if you look at individual coins, some of them, the arguments are easier to make than others. So, for example, and I always use the example of Ethereum. The founders and developers of Ethereum, if you say this is the same as Bitcoin, they would say absolutely not. There are some significant differences in the purpose, in its implementation, as well as potentially even the income sources as well. For example, the use of smart contracts. And so from a characteristic level, going from crypto to crypto may not necessarily be the same. Secondly, if you're actually doing a 1031 exchange, you have to take certain steps. Okay? It's not as if you could just one day decide I'm going to swap one house for another. You have to use what's referred to in the tax code as a qualified intermediary. And so what this often requires is planning. You hire someone in advance that's going to do the exchange, usually a business that does this. You hire them. You first then, for example, sell the house. They take the proceeds, and then the other house, they then actually are the conduit for the exchange and buy the other house. In a crypto transaction, when you're going from Bitcoin to Ethereum, there is no qualified intermediary. And certain people will argue that exchanges serve the purpose of a qualified intermediary. While this is an argument that potentially could be made, one, this isn't something that's done in advance. It's not planned. It's not arranged where you're actually contributing it and then swapping it. The use of exchange really is as if you sold it to fiat and then you've used that currency to buy Ethereum. Just on the exchange, it happens behind the scenes and you don't know it occurs. There was an article that came out today. I forget which magazine or newspaper that it was in, but the title of it was incredibly misleading. And it said that in the 2018 or the new tax reform bill that was passed, that now going forward, you can no longer exchange crypto for crypto. So this article says going forward, based on the tax reform bill that was just passed, you can't exchange crypto for crypto. Well, it was very clear in now this tax reform bill that in 2018 forward, like-kind exchanges are limited to real estate. So any other sort of property or assets that are not real estate are not included in like-kind exchanges in 2018 forward. So while I can only infer, I think Congress's intent here is for cryptocurrencies to be excluded. And based on that, now people are saying, well, is it a gray area in 17? Since there is no official guidance in 17 saying you can't do a like-kind exchange, does that mean you can? Well, it doesn't mean you can. It just means it's gray. And most practitioners in the space, most attorneys and accountants that I speak to say, in fact, it's not gray. It's pretty clearly black and white, and that a Likekind exchange should not include cryptos. So going from Bitcoin to an altcoin, altcoin to Bitcoin, whatever that may be. And that's because of the reasons that I first described. First, that the characteristics are not the same generally, and secondly, that in many cases, most cases, there is no qualified intermediary. You're just using an exchange. I've had clients in prior months come to me and say, well, what if I want to argue or do a Likekind exchange? Well, arguments can be made that it can be appropriate, but this is something that takes, again, some planning. So we should look at two coins and determine, is a Likekind exchange here, does the Likekind exchange here make sense? Are these coins comparable? And if the IRS analyzed it, how would they see it? Because ultimately, while we can take a position on a tax return, we need the IRS at the end of the day to agree with our position. So I've seen guidance on forums saying, don't worry about it, just do an exchange. The IRS will never find out, or that this is too gray. Well, if audited, the burden will be on you as a taxpayer to prove everything that's on your tax return. And so just saying, well, IRS, you're going to have to prove it, that doesn't work. If you're audited, it's on you.
Yeah.
And so if you take an aggressive position on your tax return, take the position that Likekind exchanges apply, for instance, that risk is really only on you. So the CPA or attorney that's giving that guidance, or the forum that's giving the guidance, at the end of the day, they don't have to worry about it because you as a taxpayer are responsible. Does that make sense, Todd?
Yeah, I'm absorbing it all, but it's logical. Like, I've heard the same standpoint from my accountant, and you're pretty much reinforcing what they have told me, in a little bit more detail, though, because that was one of my main concerns. And another big concern with a lot of people is, what about a loss? Like, can you write these off as a loss? Like, I keep seeing that question come up over and over again.
Yeah. So, well, the short answer is yeah. You can write off losses, and there's a few different ways you can do it. Mm-hmm. So, say, just in a very simple example, someone bought Bitcoin at its peak a week or so ago, 19,000, and then sold it today, 15,000. So let's, for conversation purposes, say they've got a loss of $5,000, and they don't do any other transactions during the year. They can report a capital loss on their tax return, but the unfortunate part of the tax code is that capital losses are limited to only $3,000 per year. Crazy. $3,000 is all you can take per year. You can carry it forward, carry it back, but every year you're only limited to $3,000. So in our example of $5,000, not a huge deal, but there's some people that are losing significant amounts, and they could only claim a loss of $3,000 a year. Now, within a certain trading portfolio, if you've got certain gains, certain losses, you can offset one another.
Yeah,
so say in your portfolio, your Bitcoin drops, but your IOTA tripled. You could use the losses from the Bitcoin to offset the profits on the IOTA, and so you could net it within a certain year in order to take those losses. But if on an overall picture you've got a loss, you're limited to $3,000. I should add, there's one caveat. There's one other way from a tax position you can take what I wouldn't necessarily say is an aggressive standpoint, but is one that would receive tax benefits if you fall within certain guidelines. And that's that you're characterized as a trader. So from the IRS's perspective, that they don't consider this being a hobby, but that you're actually in the trader business of being a crypto trader. And there's a number of different things that play into that. So, for example, that the activity is fairly ongoing, that you're trading every day, spending a significant amount of time every day trading, then you can make certain arguments that you are a trader. And also, for example, if during 3 months of the year you were trading pretty much continuously, arguments can be made that you are characterized as in the profession of a trader. And if so, then you don't have the $3,000 capital loss limitation. Then you can take additional losses because that, in fact, is your business. So that is a workaround, a loophole, if you will, that applies to certain people that have ongoing activity.
Okay, I got a question here.
Sure.
Now, I basically, everything I do is through my offshore company. Is there any benefit to that? Because every exchange account I have, every dollar that transacts, every bank account, every single thing goes through my offshore company. So is that the right position to take?
So, and I guess, Todd, just to ask a follow-up question, are you a U.S. citizen?
I'm not. Well, yeah, I'm a U.S. citizen, but I'm not a resident there. I get my foreign income tax credit.
Okay. All right. So your circumstances are a little different, right?
Mm-hmm.
Because you're living and working abroad. All right. But so I'm going to take your question. I'm happy to answer it, but I'll try to broaden it for people a little bit. For people that are living in the U.S. That have foreign corporations. Because I can talk about your circumstances, but they're a little bit different. So if you're just living in the U.S., you set up a foreign corporation. So, for example, you can trade on a certain exchange that doesn't allow U.S. people, which I hear people doing all the time. From a tax standpoint, depending on how your foreign corporation was set up, you may either have a big pain dealing with compliance, or on the flip side, you're just going to have the same tax implications as if that was a U.S. business. A foreign corporation that is only trading and only engaged in what's referred to as passive activity is characterized by the IRS as something called a PFIC, a passive foreign investment company. And these companies have not only onerous compliance requirements, but in many cases additional taxes as well. And so in broad strokes, it's not beneficial to form a foreign corporation. It may actually add compliance headaches. Some people, though, what we do is that we file that this foreign corporation should be what's referred to as disregarded, that it's not characterized by the IRS as actually a foreign corporation. It's the same as if you formed in Delaware. And if you do that, then all the profits and losses just flow to you individually, and there's no tax difference than if you just held the crypto yourself. So a very long-winded answer to say two things. One, you're not going to get a tax benefit, and two, it's a potential headache by having the crypto held by a foreign corporation. Okay. Your case, a little different because you are actually living abroad as well. If you live abroad and you're actively engaged in the business, then it's not a passive company. It's you're actively trading. And so there's different rules. But for the majority of people living in the U.S. with a foreign company, generally something that we would suggest not having, or at least from a compliance perspective, that you file it just like it was a U.S. company.
So my personal situation, though, I did it correctly, though, right?
Yeah, well, yes, because you're living abroad, you've got some different characteristics. So if you're living abroad, it's a little bit more flexible, and the rules are a little bit more beneficial. But if you're living in the U.S., opening a foreign corporation just for the purposes of trading, not going to provide any tax benefits.
Okay. All right. Well, man, that was definitely educational. I needed to hear that. We actually, let's see if we have any questions. You open for some questions?
Absolutely. Shoot them over.
All right. Can you see them on there, or you want me to read them off to you, or how you want to do that?
If you can read them, I think that'd be best.
Says, how are they?
You pick.
Okay, Jason says, oh, man, it's only showing me like 3 of the questions at a time. Okay, Elena said, what if you move the money to a trust?
It depends on the type of trust. If we're talking about a foreign trust, we've got a lot of the same foreign tax implications to deal with. If it's a U.S. trust, often from a tax standpoint, it's going to be just the same as if you were holding it yourself. So in terms of gains or losses, there's no benefit to holding it in a trust.
Okay. Yeah, everybody's asking about an LLC, but he pretty much just covered that and said it's pointless.
Well,
it's a no-no.
I just saw
it just makes a headache.
question. So a foreign corporation, generally not advisable. Now, another question, though, is do you set up an LLC in the U.S.? Set up in wherever you're living, Delaware, wherever it may be. It depends. If this is more of a hobby and you're not going to be characterized as a trader, there's generally no benefits to it because you're going to still have the same capital gain and loss limitations. But if we're going to make the argument that this is your business, you do this daily, multiple trades a day. This is all you do for a living, no other source of income. And I'm just giving you different examples that would all feed into factors that would support you being a trader. Then I would suggest having an LLC to operate under. Taking that another step, and I hate to talk about the tax reform bill that was just passed, especially with ambiguity as to when it's going to be signed. But there's now tax benefits to owning a pass-through entity. So an LLC, an S corp, under the bill, there's certain deductions for doing that. Now, within that bill as well, there's language that limits that deduction for people like myself, attorneys, accountants, consultants, and also traders. So if you're a trader, you may not be able to take the same benefits under the tax reform bill. But from my last reading, I believe that it's only if you have earnings over $315,000. So some people may be able to benefit from that. So broadly speaking, it may make sense in some cases to form an LLC and have your trading activity go through that. And so I'd suggest reach out to me. Happy to talk through people individually, whether or not it makes sense. But in some cases, it may.
I got a question. When do you feel the IRS is going to have clarification and actually have a guidelines on how to do this and file? Like, when are they going to say, listen, this is the steps you need, A, B, C, and D? Because it seems now that everything is how you interpret it, like, you know.
So, I think just stepping in the shoes of the IRS, I think they would argue that at this point they have provided sufficient guidance for the vast majority of transactions. So in 2014, the IRS released what was really one of their only statements regarding crypto, and basically defining it as property rather than a currency. And in doing so, it's very similar to gold, right? There's not all these IRS regulations that describe how you deal with gold. We just still read the same rules regarding property. And so that's why, people will say, for example, in the area of Likekind exchanges, in the area of being a trader, the IRS hasn't said crypto plus Likekind exchange equals no, okay? But that doesn't mean that the IRS is saying yes. The IRS has guidelines and information that can be applied to the circumstances of crypto. And when applying those rules, when applying that tax code to crypto, there is fairly easy analogies. There are things you can compare it to. So gold is a very common example, and often when there's certain transactions, we'll look to how the IRS has treated it in gold examples. Also, to just further answer your question, I believe that this, and many other practitioners believe that crypto is going to be a hotter and hotter topic of the IRS. Yeah. We see already the summons to Coinbase. There was also a news article that discussed how the IRS has spent money on buying software to track individuals through the blockchain. So there's at least murmurs of increased activity, but I think it's pretty clear that the IRS is going to step up enforcement action in this area. The market cap of crypto is huge. I mean, the profits that people are getting are significant. And so what better way to regulate crypto than through taxes and the government collecting money? And so people again say, well, when is the government going to regulate? Is the government going to ban crypto? No, I don't think so. I think what's going to happen instead
they're going to tax it.
The IRS is going to really step up enforcement. It's going to be taxed heavily, just like how we've seen in the last 20 years or so, increased enforcement in the area of foreign bank accounts. And crypto in many ways is like a foreign bank account. People used to think, well, stash my money out in Bermuda, the IRS will never find it. Well, they are now. Now banks are sharing all this information. And the same analogy, people are saying, no one will ever find my Bitcoin. I use offshore exchanges, it's in my wallet, whatever it may be. It's a matter of time. It's a matter of resources. We already see the summons to Coinbase. And so, I think it's really going to be a topic that we see the IRS paying a lot more attention to.
Yeah. I mean, it's fair, I don't mind paying taxes as long as they're fair about it, but if they're going to sit there and rape me for like 80% of it, then I'm going to get mad. But, if they're fair about it, that's life, we use the roads, we use the public services. We got to pay our share. So.
Yeah. Well, I would say in some ways, crypto is taxed fairly beneficially. If you hold your crypto long-term and benefit from the long-term capital gains rates, it's not too bad, 15, 20%.
Yeah.
And so, a lot of people have made considerable profits with crypto. And so, 15, 20%, not too bad. And then also with some tax planning, for example, taking losses at year end. So people contact me and say, now that it's December, what types of things can I do to minimize my tax liability? Well, if there's certain coins that you want to get out of, you're going to get out of them anyways, they're at a loss, better to do it before year end so you can offset any of those gains that you have as well. So that's just something that you can do as well. So with tax planning, you can minimize the bite of taxes.
Yeah, I see so many questions coming over, but they're going so quick, and I can't read them. Like, they're literally just, and I'm only getting to be able to see 3. And then okay. Yeah, that's another question I remember a lot of people asking. What about accidental loss? What if you lose the private keys to your wallet? Then it's just the same $3,000 a year?
So, there are certain rules under theft or casualty losses. So if you, and these rules really are regarding property. Again, we could just look at gold, for example. If you were holding gold and lost gold, there's certain rules that dictate how you can deduct it. And so if, you lost the keys, you were hacked, things like that, there are deductions that you could take for the amount of the crypto.
They're asking what it is.
And the amount of the loss that you could take, though, is your purchase price. So not necessarily the fair market value when you lost it, but how much you spent buying it. But there are opportunities to do it. There are rules that you have to follow. So it's one of those things that, I'd talk to a CPA through it and make sure that it's disclosed on your tax return properly. But yes, there are ways to take those deductions.
Okay. Well, I mean, that's fair too. Now, what else do we got here? I'm going to search the group actually, because I had a lot of questions on that post. Did you read that post I made the other day?
I've been bombarded with questions over the last week.
111 questions. Let's see what didn't we cover. I don't want to keep you all night, man. I appreciate you coming on here and doing this for. Huh? Yeah. That we didn't cover that yet. Yeah, what's going on with the forks? Technically it was free.
Forks. All right. Mm-hmm. And so this is gonna be another thing people are gonna get upset about. Not gonna like to hear it. But let's talk a little bit about forks. Okay. So, and I guess the most common or one that people are most aware of is Bitcoin and Bitcoin Cash. So the conservative tax treatment here is that when a fork occurs, it's akin to a dividend and it's reportable as income to you. You just received something new. Again, although not fiat, there's no requirement in the code that income be fiat, be cash. Income is just the receipt of anything of benefit. So if you receive now Bitcoin Cash, came out of thin air, the IRS would generally characterize this as income. People don't like to hear this because they don't have necessarily the cash, but now there's a tax due on that Bitcoin Cash that just appeared out of nowhere. Second question then is, well, what's the value of it? How much income do I report? And in the example of Coinbase, there's 2 potential dates. You have the date where the fork occurred, and then you have the date where Coinbase actually paid out the Bitcoin Cash to people. And this is one of those areas that I'd say is a little bit more gray and provides some flexibility for your tax practitioner. And so the conservative standpoint here would be that the value is the amount at the time of the fork. So as soon as that occurred, whatever the price is then, which is better for people because that amount is lower significantly than it is now. Alternatively, there's a position that, well, you didn't actually have ownership of the Bitcoin Cash until Coinbase released it to you. And so the amount is the fair market value, the date that Coinbase released it. That's not a great result for a lot of people. It's appreciated significantly. So I would say here an argument can be made that the amount of income is the value of the Bitcoin Cash the day that it was forked rather than the day it was received. people will argue that this is more akin to a stock split and shouldn't be taxable. But if you actually look at what happened, this wasn't a split of Bitcoin. While sure certain miners went off, this was the creation of something new, and that original Bitcoin didn't change in value. There's just something new that came as a result of it. So when looking at analogies, when looking at the code for other similar examples, this is something that it is pretty clear and should be considered income at the time of either the fork or receipt.
This is complicated stuff.
Yeah. There's a lot of things at play. It's a complicated area.
Yeah, it's like, and the problem is that's the issue. It's so complicated, and the person that does want to do this correctly and abide by all the laws, it's like, it's kind of difficult for them.
Yeah.
So,
yeah.
I mean, definitely got to hire a professional. That's why I don't even deal with it. I just send off all my records to my accountant and let him do all this. He told me what to pay at the end of the year. I write a check.
Yeah,
that's what I do.
Well, I think,
like, honestly,
obviously, I'm biased. Doing this for a living, but to be candid, this is one of those areas that especially if you've got a number of transactions, there's moving parts. There's a lot of pitfalls here, and so it's by just having a professional take care of it. In many ways, it's cost effective as well.
Oh yeah, I mean, you don't understand. Like, I trade daily. Like, I probably did 12 or 13 trades a day, and that's every day. So
yeah,
I just do the spreadsheets and send them off. Like, I don't even, whatever he does, he does. Yeah, man. How long do you have tonight? You gonna stay on for a little bit, or you want to get out of here?
Yeah.
I don't want to.
I can stick around for a little.
Okay.
Any other questions out there that?
Yeah, there's a suppose I'm just trying to read what we haven't covered yet. I apologize.
I could talk about mining. It's often a question people have. It's how mining is reported. You're going to take all the questions. I'm not going to have any left to answer later on. Okay. So mining. If you're mining, whenever you receive the crypto, that's income to you. So taxable upon receipt of the payouts or rewards. So even if you, again, don't convert to fiat, at the time that you receive that crypto, whatever the fair market value of that is, that's taxable as ordinary income. And so that's not long-term tax rates, anything like that. It's taxable as ordinary income. Now, say you held that crypto that you mined and then held it for a year. It doubled in value, and then you sold it. Now you've got a capital gain as well. And if you hold it for over a year, it's a long-term capital gain, 15 and 20%. So you have two components of mining. You have when you receive it, and then you also have when you sold it. So you have potentially income upon receipt, and then capital gains when you sell it. So important to track the basis at the beginning as well as the sale.
Wow, I'm not a miner, so that doesn't apply to me, but I'm sure it does to a lot of these people, They said, are the privacy coins really anonymous, and do you need to report them? Of course you need to report them. It's your legal obligation.
Yeah, and that's the question I see on forums a lot too, which is, well, if they're never going to track it, or it's intended to be confidential or private, do I still have to report? Your legal obligation is totally separate from whether or not the IRS can find it. Again, akin to foreign bank accounts. Just because you think the IRS can't find it doesn't mean that it's not reportable, and that potentially you could even end up in jail for not reporting or worse.
Okay, here's somewhat of a general question. It says, I've always heard you have a few years to file your taxes. I think it's up to 3 years, like a question mark. Could you ask him how long you can go before reporting, and what are the possible setbacks for doing so? Like, example, jail, fines, etc. You explain that for us?
Sure.
I guess he's basically saying he hasn't paid his taxes in a few years, and he wants to know what to do if he's in trouble.
Well, it sounds like he's not only not paid, but hasn't filed either. And this is a big mistake people make all the time. And we get calls like this, unfortunately. Well, fortunately for us, but unfortunately for the taxpayers, we get calls like this daily. It's people that haven't filed tax returns for years. The question suggested that you don't have to file for 3 years. That's just unfortunately false. You have a legal obligation to file every year if your income is over certain thresholds. And so there's obviously the filing deadline and then the extension deadline. After the extension deadline, that is the deadline. And then you have what's called failure to file penalties that start to accrue. What people often don't realize is that filing your taxes and paying are two separate things. What is more frequent the source of people ending up in jail or significant penalties is not filing, not necessarily not paying. And so if you can't pay, or whatever the case may be, it's still better to file your tax returns, work with an attorney to come up with a payment plan. The IRS, believe it or not, fairly reasonable in working out payment arrangements, but you should file every year. So if, for example, you have crypto transactions in prior years and you filed your tax returns, but you didn't report the crypto transactions, then generally you have 3 years to amend your tax returns. Because also generally the IRS has 3 years to audit you from the date of filing your tax return. So there are certain rules that allow the IRS to extend past 3 years, but the general rule is 3 years. And so if there were crypto transactions in earlier years, we're suggesting to our clients to amend the tax returns, report the crypto, because then if audited, shouldn't be any issues. You fully complied and reported everything.
All right, I'm trying to find another question. I'm listening to you, it's taking this all in. I filed mine, so I'm good. We already covered this. Looks like you covered most of this stuff they're asking. Okay. Here's another question that did come up. What about gifting it? Like, say, I want to give my mom something for Christmas.
Yeah, and actually, it's a great gift. I actually recently printed out some Bitcoin on a paper wallet for someone who gave it as a gift, and they're thrilled to receive it. Probably thrilled because it tripled in the last month, but thrilled to receive it. So, gifting crypto follows the same gifting rules of any other asset or property, and so on an annual basis, individuals can gift up to $14,000 to each individual. And so as long as that crypto is under $14,000, you can gift it to someone without having any reporting requirements. And also the recipient of that gift doesn't have to pay any taxes or report anything as well. If it's over $14,000, then you have to potentially file a gift tax return. And by filing the gift tax return, you don't necessarily have to pay taxes. It's a disclosure, and you're allowed to use up what's referred to as your lifetime exclusion. So each individual has an amount that they could gift in their lifetime up until the tax reform bill. Well, I guess it hasn't passed, so it's still, I believe it's 5.5 million. The tax bill, I believe, doubles it to 11. And so that's the amount that someone can gift either during their lifetime or upon passing without having to pay taxes. And so say, Todd, you want to gift me 20 grand of Bitcoin, which thank you very much for doing. You would then have to file a gift tax return. Your accountant would reduce your lifetime exclusion by that 20 grand. I don't have to report anything as income, and you don't have to pay any taxes. The follow-up question to that, though, is when I sell it, what is my basis and how much gain do I have to report? And so receiving a gift, my basis is whatever your basis was. So say you bought it at $1,000, appreciated to 15. You then gifted it to me. My basis is now $1,000. So then say you gift it to me today, and tomorrow I go sell it, $15,000. I now have a taxable gain of $14,000, and I'll have to pay taxes on that $14,000. This is different than if you passed away and someone inherited it. In certain cases, then you could have what's called a step up in basis, or you would then have the fair market value at the time of passing. But that's not gifting, it's inheritance. So in these types of situations, you've got the $14,000 annual exclusion or a gift tax return you've got to file.
Oh, man. All right. That's a lot to take in. It's like I'm trying to absorb all this at once.
Yeah.
It's good information, though.
It's a lot. It's a lot.
Yeah, I mean, I appreciate it, though. I definitely learned a lot from you tonight. Hopefully everybody else watching has. I'm trying to skim through here real quick, make sure we covered everything. Covered it. Yeah, I mean, other stuff is like foreign tax questions, but obviously you're not, going to be able to answer those. Yeah, I think we pretty much covered everything that I can say.
There's something about is there two different methods to gifting, and I guess I'll just try to clarify that maybe, and then we can end if there's nothing else. So there's not two different methods. It really depends on the dollar amount. If it's under $14,000, you can do it without having to file anything per individual. If it's over $14,000, then there's certain filing requirements that you have to deal with.
Okay. Oh, man. I'm looking at this market, man. We're getting smashed.
I hear what's Bitcoin at right now?
14,000. About to lose 14,000.
Well, I accept Bitcoin gifts to me.
Good thing I shorted this thing, man. Yep, lost 13,955. I mean, this thing's coming down hard, man. I knew this was going to come down hard, but this is coming down hard. Oh, man. Ether's at 706. Litecoin's at 260. I mean, wow. It's coming down hard. So, oh, man. Any final thoughts? I don't want to keep you on here forever tonight. I definitely appreciate you coming on here, explaining it to everybody.
Thank you very much for having me, Todd. Thank you, everyone, for watching and sending me your questions. If you do have any other questions, feel free to message me on Facebook. Twitter handle is the easiest, @accounting. Feel free to post questions there, and I'll be happy to post responses on the group.
Okay, yeah. I'm going to get your business card or whatever type information from you, and I'm going to go ahead and link that with the YouTube video. This video is going to be uploaded to YouTube, so if anybody missed it or whatnot, or you guys over again, if you guys need clarification on something, I should probably have that uploaded in the next hour or two, and it'll be on 51% crew page, and I'll leave this up. So I appreciate it, Andrew.
Right.
I'm going to hop on off here and check these trades out.
Well, thank you.
Everyone have a good night. See ya.